All right, welcome back to The Explainer. Today, we're diving straight into CrowdStrike's absolutely explosive Q2 earnings report. Now, if you've been watching the markets, you already know they just had this massive post-earnings stock jump, soaring over 20% in a single day. But what we really want to figure out today is this. Is that massive leap actually sustainable, or is this stock now just priced for absolute perfection? We're going to look at the data directly from the source to try and make sense of this massive move.
So, here's the game plan for today. 1. A record-breaking quarter. 2. The AI growth catalyst. 3. Valuation and competition risks. And finally, number 4, the final investor verdict. Okay, let's jump right into part 1, a record-breaking quarter, and look at the actual details behind that 20% stock jump.
Let's kick things off with the hard numbers that caused CrowdStrike's stock to surge to roughly $228 a share yesterday. Revenue came in at a staggering $1.47 billion. That is a near 26% year-over-year jump, which absolutely crushed consensus estimates by roughly $30 million. And it didn't just stop at the top line either. This was alongside an adjusted earnings per share beat of 4 cents. But here is the kicker, especially for a subscription-based security company. Take a look at this. $333 million in net new annual recurring revenue, or ARR. This metric measures exactly how much brand new business they are adding to the books, and it represents a massive 51% year-over-year increase. It completely blew past management's own guidance and what analysts were expecting. When you're looking at a software-as-a-service business, this is the holy grail metric, and CrowdStrike just knocked it out of the park.
And with total ARR hitting an impressive $6.6 billion, they also generated a Q2 record free cash flow of $377 million. The crazy part? They did this with expanding margins, hitting 25.3%, which is a really rare feat when you're growing this fast. So this wasn't just a revenue beat, it was a beat with improving quality across the board. It's no wonder management confidently bumped up their full-year outlook across all metrics, signaling they're expecting accelerating growth through the back half of the year.
Moving on to Section 2, the AI growth catalyst. Let's talk about what's actually driving this surge.
The underlying why behind these explosive financials is super fascinating. CrowdStrike CEO George Kurtz described this current environment as the cybersecurity industry's MYTHOS moment. And when he said this, he was explicitly nodding to Anthropic's latest AI model release. But, what does a MYTHOS moment actually mean for a business in the real world?
To define it clearly, a MYTHOS moment is that sudden, intense urgency for enterprises to defend against a rapidly expanding attack surface. Think about it. Advanced AI models, like Anthropic's Claude and OpenAI's GPT, are actively being deployed inside highly secure enterprise environments right now. These AI agents have incredibly broad access to sensitive internal data, probably the same systems your own company uses every day. This whole dynamic has created a sudden and very real need for modern AI-native security platforms that can monitor these agents in real time. Traditional security? Yeah, it just wasn't built for this.
And to put the sheer scale of this threat into perspective, check out this stat from JP Morgan. They reported that AI agents operating actively inside enterprise networks grew by an unbelievable 466% year-over-year. That is wild. When your attack surface expands that rapidly, enterprise IT budgets literally have to shift overnight to plug the holes. And that is exactly the way CrowdStrike is riding right now.
So how are companies combating this 466% surge? Well, they're rapidly consolidating their security spending. Instead of buying 10 different tools from 10 different vendors, they're just moving it all onto CrowdStrike's Falcon platform. Specifically, they're buying into the Falcon Flex subscription model, allowing them to consume multiple security modules under one flexible agreement. This specific product has doubled year over year and now exceeds $2.3 billion in ARR all on its own.
Okay, let's take a breath and move to Section 3. Valuation and competition risks. It is definitely time for a reality check.
This right here represents the single biggest debate on Wall Street right now regarding CrowdStrike. At roughly $228 a share, they trade at an extreme 32 times forward revenue, with a forward PE ratio exceeding 130. In plain English, investors are paying a massive premium today for sales and profits the company hasn't even made yet. To put that in perspective, the broader cybersecurity industry median is about 10 times forward revenue. Even a high-quality peer like Okta trades at just 7 times forward sales. So you are paying an astronomical premium for CrowdStrike's growth.
Independent research from Morningstar frames this risk perfectly. Their fair value estimate for CrowdStrike is just $152 per share. Their absolute best case, everything goes perfectly, bull case scenario values the company at $230. With the stock currently sitting right around $228, it is quite literally fully priced for perfection. At these levels, there's absolutely zero room for execution error. If they miss expectations by even a fraction in the coming quarters, the market could severely punish the stock.
And, adding to that valuation pressure, competition is intensifying incredibly fast. We're not just talking about legacy security firms, it's the AI creators themselves. For example, back in February, when Anthropic announced a new feature called Claude Code Security, CrowdStrike shares dropped nearly 8% in a single trading day. It's a pretty stark reminder that AI-native entrants can disrupt the landscape instantly, and CrowdStrike is going to have to constantly fight to maintain its moat.
Which brings us to Section 4, the final investor verdict. Let's talk about how to actually position yourself. Let's weigh all this conflicting data to get our final assessment. On the bull side, you've got CrowdStrike as the premier asset leading a structural, multi-year AI security cycle, and massive platform consolidation is driving durable, high-margin growth. But then on the bear side, the argument is equally compelling. You have an extreme valuation, rising AI-native competitors, and the reality that any minor execution misstep will be heavily punished. When you look at it this way, the risk-reward profile feels pretty precariously balanced. Therefore, our final verdict for this explainer is to rate the stock a hold at these current levels. Look, the fundamentals are excellent, but the source data suggests the upside requires totally flawless execution. The consensus strategy here points to waiting for meaningful pullbacks below $200 for a much more attractive entry point, giving yourself a much better margin of safety. Whether you're an aggressive growth investor holding onto your shares or a value-conscious investor waiting to buy the dip, you need to closely monitor these 3 key metrics every single quarter. Keep your eyes on net new ARR growth to ensure they're still capturing the market. Watch the Falcon Flex adoption rates to verify that consolidation trend is intact. And finally, stay hyper-aware of competitor announcements, especially from those fast-moving AI-native players.
CrowdStrike is undeniably riding a massive secular wave, and they are executing brilliantly right now. But as the stock is already up over 100% in just the past 52 weeks alone, I want to leave you with this final pivotal question for your own investment strategy. With perfection already expected, is the entire AI security narrative already fully priced into CrowdStrike stock? Think about that as you review your portfolio. Thanks so much for joining me for this explainer, and I'll see you next time.